There was a time where we thought inflation was dead. It was never going to raise its head once again. And then COVID happened. It caused great dislocation in the global economy, and suddenly there was runaway inflation, and central bankers got really anxious about it. And all of us ended up paying a lot more on our debt. And for many people, they became seriously financially unstuck. We are in a phase now where inflation has fallen quite substantially and where interest rates around the world are reducing. And that then brings a new set of challenges. Certified financial planner Warren Ingram, what are those challenges as interest rates fall and money becomes more accessible?
I think there's probably the couple of steps. One, that we get increased volatility. In other words, stock markets and bond markets try to anticipate what's going to happen, and every time there is a piece of news from a central bank somewhere, a meaningful central bank, about what they think inflation is doing, and therefore what they'll be doing with interest rates, it either causes stock markets to boom or to bust, and that creates volatility, and it happens in the stock market and the bond market. Now, we've done previous episodes about trying to anticipate markets, and certainly that's your first job when we're talking about interest rates turning, and potentially going from higher to lower. What you need to know is it doesn't happen in a nice, smooth, straight line. It happens in kind of a really messy pattern. So over a period of time, gradually inflation will fall, and somewhere along the line, central banks, who are notoriously not quick to move, they will start to cut interest rates. Your job when you're doing all of that is to say, well, if I've got debt, then I'm going to have some breathing room now, because my debt servicing costs are going to be a bit less. That's very good. What you do with that money, that extra bit of money you've got, is you go and pay off some more debt. So if your monthly repayments at the interest rate peak were 1,000, then keep paying 1,000, because you're going to knock your debts that much faster. What you need to know is we're in an environment where interest rates are very unlikely to go back to zero. And so interest rates are going to be there. Your money will cost you some money if you owe money, and you will earn some if you have a cash on deposit. So in the beginning, while you owe money, try and get it down and out of your life as fast as possible. Falling interest rates become good for those who keep paying. Equally, if you've got money in the stock market and you've been desperately worried about, are you going to ever make money out of the markets? Are things ever going to recover? Understand falling interest rates are very good for property investors, bond investors, and stock market investors. Anything where interest rates turn and go down, that will drive growth assets. And I think that's a key here, Bruce, is don't get stuck in the noise of inflation didn't fall by the extra 0.1% that we all anticipated. What you need to know is falling interest rates over a 5-year period, very good for growth assets, terrible if you're a cash investor, and wonderful if you have debt and you are starting to pay off that debt at a faster rate. You cannot take that money and go and buy yourself those extra cups of coffee. That's not a good thing to do with that gap that the debt has given you, and all the falling debt.
Certified financial planner Warren Ingram, our action this week, therefore, is to ensure that our payments on our debts stay steady at the elevated rate that we've become used to. We've tightened our belts. Don't be tempted to expand your spending as rates come down. Next time, Warren, I want us to talk about the investment opportunity as rates come down and whether or not you've missed the boat already. Next time on the Financial Freedom Pod, I'm Bruce Whitfield. He is certified financial planner Warren Ingram.